Brace yourselves, the U.S. Federal Reserve is expected to raise interest rates for a fifth time this year as part of the ongoing efforts to curb inflation.
Well, experts predict that the Fed will raise rates by at least 0.75 of a percentage point at a meeting of central bankers on Wednesday. It would mark the third consecutive increase of that size, which was already a record. The meeting comes as the U.S. inflation rate hovers near 8.3%.
Thomas Hogan joins us now with more. He's a senior fellow at the American Institute for Economic Research. Thomas, welcome. All of this is meant to tamper inflation, which everyone is feeling in many different ways. It's painful for most Americans. But how would another interest rate hike in the short term impact people?
Thanks. That's right. The Federal Reserve is the central bank of the United States, and they manage the money supply by buying and selling bonds and also, raising and lowering interest rates. And as you said, they're expected to raise interest rates tomorrow by about 0.75%. And they're hoping that that will have the effect of slowing the economy just enough to bring down inflation, but not have negative effects on economic growth or the labor market. Americans have been feeling the pain of inflation, 8.3% over the last year. And so the Fed hopes they can bring that down a little bit without too many negative consequences.
Well, there is going to be other pain, though, Thomas, because especially for Americans carrying a credit card balances, it's going to be something that hits them potentially in a difficult way. Are the Feds looking for the current inflation rates to actually drop? It does seem like they have abated. Prices, however, seem to still remain high. What exactly is the Fed looking for? And do we expect that prices are actually going to come down?
Right, it's true. We've had continued inflation for more than a year now, and the Fed has been predicting for more than a year that inflation would be coming down. They thought early on, a little more than a year ago in the summertime, they thought it was just due to supply issues. But instead, we've seen persistent inflation across the economy, and it's lasted a lot longer than they thought. Even in the last few months, they thought that inflation would probably have come down. The last 2 months, it's been roughly flat. And so the CPI number we got last week was a bit of a surprise because people thought that it would be declining and instead remained high. And so that was kind of a shock. The Fed is therefore expected to raise interest rates by about 0.75 of a point, but people are saying they could do a full point. We'll have to see. They've mostly been coming in on the low side of expectations, but they say that they're taking inflation seriously. They say that they understand how difficult it is for most Americans and that that's going to be their #1 priority.
Is there something we're missing, Thomas? Because even many of the economists said that they didn't expect inflation to be so pervasive, to persist for so long. And as you look at the data now, is there anything that to you gives you pause, that makes you wonder, like, look, maybe, increasing interest rates isn't the only solution that it will take to bring things to a more affordable level?
Yeah, I think the Fed has been repeatedly surprised with how persistent inflation has been. Fed Chair Jerome Powell has said that their models just didn't take into account how long this would last and thought that it was just going to be a short-term phenomenon. Now the inflation numbers that we're seeing are even though the total has been stable, there's been a bit of a problem that inflation has just crept everywhere in the economy and is in prices across the board. And so that's a much bigger problem than if it were just concentrated in a few areas. And so seeing that kind of widespread inflation makes the Fed very, very worried that this is going to be a much longer lasting phenomenon. Consumer expectations also have been a problem because at first consumers believed the Fed that inflation was going to come down. And now they've kind of lost faith in that. And so the Federal Reserve is very worried that the public will start expecting much longer persistent inflation. And so they're saying at least that they're going to err on the side of caution here by potentially raising interest rates and maybe slowing the economy a little bit more just to make sure that people don't start expecting widespread persistent inflation for years to come, because that's not what the Fed wants. That could be the worst case scenario.
Right. I mean, I guess that's what's so troubling. No one wants to see interest rates go up,
right,
but then you don't want to see that jump and then inflation continue at the same time. But good to get your assessment. Thomas Hogan, thank you very much.
Yeah, thank you.